Good morning. The self storage market report for 2025 and what investors need to know. So, the self storage industry enters 2025 with cautious optimism, and performance varies widely by market type, operator profile, and supply pipelines. But three themes define today's landscape: tertiary market liquidity challenges, and there's no clear herd mentality among operators this year. And there's early signs of rate stabilization in select supply disciplined markets. So below is going to be a organized breakdown designed for commercial real estate investors, self-storage owners, lenders, acquisition teams, all people who are looking to understand today's market direction. So the first category is tertiary markets. Liquidity remains tight. And across conference conversations and operator interviews, one challenge continues to dominate, which is moving self storage assets in tertiary markets is just difficult. There's a smaller buyer pool, is really the answer. And investors willing to purchase tertiary self storage assets have tightened dramatically. And there's flat performance or pro forma heavy underwriting, and that kind of really turns buyers away. So deals price based on 22 and 23 expectations are no longer clearing the market is the real takeaway. And there's been a shift in buyer strategy. For years, many groups have adopted a portfolio approach, spreading assets across primary, secondary, and tertiary markets. And today, buyers prefer markets with more stable demand. So think a major metro is really the concept. Clear rate recovery trajectories have been put in place, and I think that's going to be overall positive for the market in general. But there's lower new supply risk right now as well because of where interest rates are at. So this reallocation is pushing tertiary values down, often materially below expectations set 18 to 24 months ago. And where the deals are happening? Well, despite challenges, tertiary deals are still closing when operators already have a regional footprint in the area and buyers possess operational efficiencies in that specific market or geography. And as always, assets that are well run and produce consistent occupancy are going to be the first chosen. So, however, the broad, fast moving tertiary trades of recent years have slowed significantly, is the takeaway. Number two is there's no herd mentality in 2025. So it's a deal by deal kind of market. In both the Austin and Las Vegas SSA conferences, one theme stood out. There's no dominant acquisition or development strategy this year. And operators are divided. Some are aggressively buying, believing pricing is near the bottom. And others remain completely inactive and cautious. And really, it comes back down to high capital costs and uncertain demand. And then there's still many who are selectively active, chasing deals only within tight geographic or operational filters, so larger MSAs. And unlike prior cycles, build everything, raise rates everywhere, or buy any undermanaged deal, 2025 is not that herd mentality kind of year. Operators are moving independently, guided by micro market fundamentals, rather than whole industry wide narratives. And number three, have rates finally stabilized? Well, early signs say yes. And in some markets, there's a definite yes. So Yardy's data for September of 2025 shows that the first signs of a real turning point after nearly 3 years of downward pressure. And here's some national indicators. National year over year advertised rate growth is 0.9%, and asking rent per square foot is about 16.8. And that's directionally positive, even if it's modest gains. So in the space, you have REIT versus non-REIT operators. And REIT same store advertised rents are up 2.6 year over year, whereas non-REIT operators are up 0.1%. So why the difference there? Well, REITs benefit from scale is the first clue right there. They have centralized pricing technology, which is more homogeneous across their markets. And they have superior digital marketing, so they get more eyeballs on their locations. And being a REIT with self funded, they have lower capital costs as borrowing it on the open market. So the real takeaway is rate stabilization is emerging, but only in markets where supply is under control. So think Sunbelt metros with heavy development pipelines are going to take longer to recover. So here's some economic context. And inflation is trending toward normal these days. Inflation peaked in 2023 and moved towards a more normalized range through 24 and even further in 25. And inflation's now hovering near the Fed's informal comfort zone, and it supports the case for gradual rate stability, which could help self-storage fundamentals as well as the broader market stabilize further at the end of 25 and into 26. So here's the conclusion. The self-storage industry in 2025 is defined by selective opportunity and not broad momentum. Tertiary markets remain difficult unless operators have regional scale. And I think that's pretty common across a lot of asset classes too. Investment strategies are fragmented and there's really no clear consensus. But the key here is that rate stabilization is emerging in supply discipline metros. So what this means for investors and owners, this is a market won by precision and not by volume. So focus on your underwriting discipline, operational strengths, and micro market knowledge will really determine who succeeds from this point forward. That, my friends, is it for the day. Please visit my website, HoustonRealEstateBrokerage.com. You can register for some free tools. You can also schedule a consultation. That is it for the day. Have a good one.